Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. One of the elements that affects the cash flow and overall return of real estate investments is taxation. And while nobody really likes to talk about it, there's lots you can do to reduce taxes and make more money. Today, we're going to talk about current and proposed tax changes that real estate investors must understand. And we have an amazing guest on the Real Estate Guys radio program.
When the world changes, investing strategy changes too. The coronavirus is disrupting economies, financial systems, and daily life like nothing in modern history. Sheltering in place might protect you from the virus, but a wait-and-see approach to investing now is like pulling the sheets over your head while the house burns down. It's not the time to be complacent. So we're calling our huge network of thought leaders, seasoned investors, and technical experts to find out what they're seeing, thinking, and doing to mitigate risk and capture opportunity, and we're recording all of it. We're calling it our Coronavirus Crisis Investing Webinar, and it's totally free. All you need to do is register. Remember, mainstream media doesn't talk to real estate investors. They don't understand you because Wall Street pays them not to. That's why the Real Estate Guys are here. To register for the Crisis Investing Webinar, simply send an email to crisis@realestateguysradio.com. That's crisis@realestateguysradio.com. Real-world wisdom is the best vaccine for a healthy financial future. Send your email to crisis@realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. With me, as usual, it's our financial strategist and co-host, Russell Gray.
Hey, Robert.
We love real estate for a variety of reasons, but one of the things people talk about is the tax benefits of real estate. And oh my gosh, is it true? Our good friend Tom Wheelwright always says if you study a nation's tax code, you can see exactly what they want, the behavior they want, because they reward it. And the tax code is a series of incentives. And there's so much going on now. And in an election year, a lot can happen. And so I want to preface the show by saying that we don't have a political argument to make of any kind. We're pretty agnostic at the Real Estate Guys. But when you start talking tax policy and you have different parties with different opinions, politics are going to come up. So that's just fair warning. And also, this has been an extraordinary year with the changes. And so we want to get our minds around what some of the changes could possibly be, as well as find out what's happened with the CARES Act.
Yeah, well, it's actually, from a tax standpoint, been extraordinary for quite a while, going all the way back to Obamacare. That had a tax impact, and then the Trump administration came in and made the first major overhaul. And a shocker, with a real estate guy in the White House, we got something very favorable for real estate investors, and we've been giddy about that for the last couple of years. Of course, Trump is a controversial character. We've got this COVID-19 crisis that has impacted the tax code, and we're going to talk about that because they're trying to find ways to direct money to where they want it to go. And some of that is in stimulus, and tax is a form of stimulus. And so it gets involved a lot in policy. And of course, policy affects you, at the street level and the things that you do, how much money you have to work with, where you get the best advantages. We've been very happy about bonus depreciation for quite some time because it makes that early year of owning the property, when the cash flow is the most difficult, when you're trying to get it stabilized and optimized and all the things you're trying to do, and you got to suck up all your acquisition costs. Bonus depreciation really helps you get over that hump. It makes acquisition a whole lot easier. And so now we have politicians that are competing with the Trump administration, floating ideas about what they would do if they were to get the reins of power. Now, whether they would do it or not remains to be seen, but the fact that they're talking about it, I think, are things that we should talk about, because it's not just been kind of steady change. We did a newsletter a couple of weeks ago where we showed the Fed balance sheet, and up to 2008, it was just a stable, steady, very stable, slowly growing, but it was just like this flat line, very smooth. Afterwards, kind of like a roller coaster. And I think that since 2008, there's been just extreme changes in tax code and public policy and public behavior, financial markets. It's quite a bit more volatile than it's been. And that just means, as a real estate investor, you got to be looking a little bit further down the road. You have to be well advised, and we've got a great advisor with us today. And you need to be proactive. And so that's what today's show is about, is talking about some of the changes that are potentially looming, what we should be thinking about, aware of, and hopefully what we can do now to be in position to take advantage of opportunity or mitigate risk.
All real estate investors have to have a cursory knowledge of taxation. You don't have to specialize in it. You don't have to read every word, but you certainly need to understand the principles. And on this show, you probably know, if you're a listener, that when we talk about tax, we pretty quickly say, now, we're not tax advisors or professionals. So today we've got a great one for you. Our good friend and best-selling author Tom Wheelwright's on the program today when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
If you want to learn how you could potentially increase your net worth by over $1 million and quit your job in just a few short years, listen closely for the next 60 seconds. This is Brad Sumrock, and over the past 16 years, I've helped thousands of people invest profitably in real estate, but not just any type of real estate. I specialize in helping people syndicate large apartment buildings so that they can be business owners and investors. In today's competitive environment, it's even more important than ever to leverage an experienced mentor, invest in your education, and have a team of advisors that has established relationships nationwide. And so many people right now seem to be struggling to find deals and then get them funded, but yet Sumrock students are thriving in today's marketplace. We've purchased nearly 7,000 units and nearly $1.5 billion in purchase volume over the past 12 months. And with the new Trump tax laws, apartment investors are positioned now better than ever before to pay even less in taxes. To find out more, send an email to apartmentsnow@realestateguysradio.com and you'll get my recent presentation called Why Apartments Now. That's apartmentsnow@realestateguysradio.com.
Hey, it's Kyle Wilson, Jim Run's 18-year business partner, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station and all the time at realestateguysradio.com and your favorite podcast outlets. We're talking today about the changes and potential changes coming to our tax world. And let's welcome back to the program our good friend and the author of the amazing book, Tax-Free Wealth, CPA Tom Wheelwright. Hey, Tom.
Hey, good to be with you, Robert. Always.
It's always good to be with you, my friend. We were just talking about the fact that you made a great contribution to our last Secrets of Successful Syndication, to this year's summit. You're a big part of our crisis webinar series coming up. So we've talked a lot, but we actually haven't had you on the show all year. And this has been a crazy year.
Yeah, it really has. And it's been crazy, not just from a pandemic and everything year, but it's been crazy from a tax standpoint. You know, not only do we have a presidential election, which forebodes a lot of potential changes in the tax law, but we've actually had major changes just in a way to stimulate the economy through the CARES Act, had major tax changes, and I frankly expect some more to come.
Well, and let's talk about that, because you've done a great job at many of our events talking about this very thing, and certainly studious in tax, but we don't necessarily think of something like the CARES Act of being so tax-oriented. But as Russ pointed out, tax is stimulus, and so you've really dove into this. Kind of give us the nickel tour on what real estate investors need to understand about the CARES Act.
So there were some really important changes, I think, for real estate investors. I think that, you know, the most obvious one was we had the qualified improvement property change, which was long awaited, because that was just a mistake in the 2017 Act, where they didn't include leasehold improvements. And this is commercial property, by the way. This is not residential property we're talking about.
Yep.
This is commercial property where leasehold improvements didn't qualify for bonus depreciation, and the CARES Act said, yeah, now they do. And they do retroactively. So all the way back to 2018, and you can actually either amend your return or you can do a catch-up.
Right.
That was actually a big one because leasehold improvements, that's a lot of money. When you're improving a space for a tenant, or whether the tenant's improving their own space, that can be some pretty big money. So that was the most obvious one from a real estate standpoint. But there was the one that I think is the least obvious, that's probably the most important for real estate investors. You've heard me say many times, Robert, that I hate the idea of investing in real estate through an IRA or 401k or a pension plan. I think it's a bad idea to put one tax shelter inside another tax shelter, because what you end up with is you actually end up with a taxable event. Okay, so you take something that's already non-taxable, which is real estate, you put it into an IRA, you buy it through an IRA, then when the money comes out, it's taxable. So you converted non-taxable to taxable. I don't know why anybody would want to do that. And plus you lose your leverage, which of course is, in my mind, the biggest, outside of tax, the biggest advantage of real estate from an investing standpoint. So what the CARES Act did is, if you had to reduce your hours, either your business hours or your working hours because of the pandemic, then you can pull out up to $100,000 from all your accounts put together, but up to $100,000, you can pull it out, and you have two choices. You can either pay tax on it over 3 years, spread it over 3 years. It's like the old income averaging that we used to have. Or you can actually put it back in 3 years and not be taxed at all. So you could literally take it out, buy a property, take care of the property, sell the property and put the money back, or keep the property and borrow against the property and put the money back. So anybody who is a real estate investor and seriously doesn't want their money tied up in their IRA or their 401k really ought to be doing this if they can qualify. Now, not everybody qualifies, but if they can possibly qualify, they ought to do that one. There were a few others, quick nickel tour on the others. The $500,000 loss limitation, which doesn't affect very many people, frankly, because your losses, especially from real estate, could offset even wage income. Okay, they just couldn't offset investment income like dividends and interest. So that went away. The other big one was the net operating loss carryback. So in 2017, we lost the ability to carry back net operating losses. In 2020, we gained the ability, and we gain it for 2018, 19, and 20, and it's a 5-year carryback. Now, 5 years is a big deal because you're talking about going back to 2013, 14, 15. These are years that for a lot of people, they were really good years. And let's say you weren't a real estate professional in those years, you weren't really doing real estate, and now you've been doing real estate because you've been following the real estate guys, right? And so you've been doing real estate the last 2 years. Now you've got bonus depreciation. You or your spouse is a real estate professional. You generate this big loss. You can carry it back to years you were not a real estate professional and offset your income and get a refund. So this is a way to free up cash into the economy. That's the stimulus. Free up cash into the economy by allowing you to carry those losses backwards.
Wow.
And getting refunds. And frankly, everybody ought to be on top of that one because the House of Representatives has proposed getting rid of that benefit already. So they don't like that benefit like the Republicans don't like the $600 a week unemployment check. So those two are, I think, on the chopping block in this next stimulus package. And by the way, the fifth tax benefit that people don't talk about is the charitable deduction tax benefit, where typically we're limited on, we can only deduct up to 60% of our charitable contributions. And in 2020, it's 100%. So that's, if you want to give all your money away this year, the government says, go for it. We will give you a deduction for it.
Excellent. Well, that was an awesome nutshell of what some of the things are. And of course, depending on each individual situation, they can explore different options. And the same is true for some of the loans that have been available. And even though this isn't quite your area of expertise, I know you know a lot about this. Maybe take us quickly through the State of the Union on that part of the stimulus package.
So we basically have three So let's start with the EIDL grant. This was $1,000 per employee up to $10,000. This was a grant, and a lot of people got it, okay? And you applied for the grant. Then you applied for the PPP loan, and the PPP loan is forgivable. Now, if you get the grant and the PPP loan, the grant reduces the amount of the PPP loan that is forgivable. So that means that even though the grant is a grant, now you still have, let's say if you got $8,000 in that EIDL grant, now you owe $8,000 back on your PPP loan that you cannot get forgiven. Now, let's make it even more complex because we're Congress and that's what we like to do. So what we're going to do is when you applied for that grant, you probably didn't know that you were also applying for a loan. And most people who applied for the grant and got the grant also got the loan. And the loan was up to $150,000. And it's a great loan. It's a 30-year loan, 3.75%, deferred payments for a year. I just think, boy, if you had the opportunity to get that loan, you ought to take that loan. I truly believe that, just because, you never know when you're going to need cash. You never know. And we all know, okay, you guys are experts in this. You all know that the best time to borrow is when you don't need the money.
So true.
Right? If you wait until you need the money, the bank's going, yeah, you're not good for it. But if you get it now, and with the EIDL loan, there was like nothing you had to do. And it's not like personally guaranteed or anything. So now it can only be used for certain purposes, but it's cash to have on hand. And by the way, your grant is not part of your EIDL loan. Your grant is part of your PPP loan. So
right.
They're different. And then you have the Main Street loan program, right? And the Main Street loan program is a completely different program. Is actually, so I know, Russ, you've got to love this, because this is a loan not from the SBA and not from Treasury, but from the Federal Reserve is the one who's actually making this money available directly to the banks. The banks lend the money. They do all the, they do the legwork on it, but it's taken over by the Fed. So it goes onto the Fed's balance sheet. So that's another one where, the terms can be really good, and and that one actually has a lot more availability for how you can use it. And so if you're thinking that, boy, I might need money in the next 12 months, that would be a good place to go.
Tom, a lot of real estate investors who don't necessarily have employees or a lot of employees kind of thought at first, well, these loans really aren't designed for me. But I know you have clients and real estate investors that have found this to be a pretty good source of capital right now.
Well, okay. So first of all, let's say that you have employees that are, you have a management company, and a management company has employees. So you could easily qualify. I mean, I know big syndicators that they have lots of employees that are in their management company, and so they got the PPP loan for their management company. The EIDL loan doesn't have an employee component of it, so you can get that directly for your real estate. And let's face it, a lot of people needed that money for their real estate, especially when you're in commercial real estate, because a lot of buildings are going empty right now because of this crisis, or tenants are not renewing, or they want smaller spaces. So I think that EIDL loan is a good one for real estate investors. And then, of course, the Main Street loan is available for real estate investors too. So again, I think real estate investors, you think, well, no, it doesn't really apply to me, but it may very well apply to you.
Our guest today is CPA Tom Wheelwright. We're talking about taxes, one of his favorite subjects, and really what it means to real estate investors. We've got lots more when we come back. Plus, we'll play real estate trivia and give away a copy of Tom's book next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you've ever wanted to do bigger deals using other people's money, or if you want to passively invest in deals that are bigger than you could do on your own, then it's time for you to attend The Secrets of Successful Syndication, our 2-day course on aggregating capital and investing together. It happens at the end of September, either live in Dallas or virtually. You can get all the details on the website at realestateguysradio.com under events. We're talking about current and proposed tax changes that real estate investors have to understand. And before we return to our interview with CPA Tom Wheelwright, it's time to play real estate trivia and give away his great book. Here's how it works. In just a minute, I'm going to give you a real estate trivia question. When you think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You want to include your name, the answer to the question, and your physical mailing address. You're the winner. We're going to send you a copy of Tax-Free Wealth, the updated edition. If you already have it, many of you do, well, you can give it to a friend. Last week on The Real Estate Guys, we had Tom Wheelwright's good friend and another rich dad advisor, Ken McElroy. Purely a coincidence, but Kenny shared some great wisdom with us. So if you missed that show, go back and check it out. Here's the real estate trivia question we answered on that show. Name the tallest building in the state of Maine. Well, it's the Agora Grand, located in Lewiston Heights. It's 220 feet tall, not that tall for a building, but Maine doesn't have a lot of sky rises, and it was completed in 1890 as St. Patrick's Church. And it also happens to be the oldest building in the state of Maine. Here's our real estate trivia question for this week. Tom likes to update us on tax law, but there's a lot more law than that. Here's the trivia question. It's against the law to eat a certain food on Sunday in St. Cloud, Minnesota. What food is that? Yeah, which food is it illegal for you to eat on a Sunday if you're in St. Cloud, Minnesota? If you live there, you may know. If not, you may need to guess. Send your best guess to trivia@realestateguysradio.com. Include your name, your guess, and your physical mailing address. So if you're the winner, we can send you Tax-Free Wealth by Tom Wheelwright. What food is it illegal to eat on Sunday in St. Cloud, Minnesota? That's today's real estate trivia question. We're talking with the author of that great book, Tax-Free Wealth, the updated version, in fact. And Tom, you had written Tax-Free Wealth and been a bestseller, and then all of a sudden the tax law changed, and you basically had to rewrite the book.
Well, there were definitely some improvements. Actually, in a way, they were just all improvements, right? The 2017 Act was a massive tax cut, regardless of what the opposition to the tax cut would say. It was really a massive tax cut for almost everybody. And even though the book is intended to be international, it's not as U.S. specific as you might think it would be. There were just some major changes, like the qualified business income deduction, like the bonus depreciation, that we really did need to update the book. And so that's why it's actually a second edition.
Yeah, good stuff. Speaking of which, we started the show with this premise of in an election year, we're going to have proposed changes. We're going to have maybe real change. Who knows what's going to happen? But I think as real estate investors, we need to be prepared. And you mentioned about the opposition to the tax. There's always going to be somebody who feels like whatever happens isn't the right thing, whether it's healthcare or socialism or whatever it is. And in this case, the tax change that we got under the Trump administration, favorable to a lot of folks. With the election year, the candidate for the Democratic Party, Joe Biden, has come out with his tax plan and some ideas. And I know you're up to speed on this. Take us through just so we have an understanding of what some of those plans might look like.
So Joe Biden's tax plan is basically a tax everything tax plan. It's basically a get rid of all of the stimulus of the Internal Revenue Code outside of stimulus that is handout stimulus, right? Personal stimulus. He would really eviscerate the tax law if he had his choice based on his proposals, leading me to wonder, does he understand the tax law at all? Because what he would do, for example, all the real estate tax benefits would go away. He wouldn't eliminate cost segregation, but would he eliminate bonus depreciation? Absolutely, he said he would. Frankly, there's, from a policy standpoint, not a lot of a good argument for bonus depreciation on used real estate. So that one is probably an easy one for him to eliminate, because it's pretty tough to make an argument that you should have bonus depreciation on used real estate. But he would probably eliminate bonus depreciation entirely. He would certainly has proposed eliminating 1031 exchanges. He's proposed eliminating the basis step up when you die. He's proposed a massive tax capital gains increase on any capital gain in excess of $1 million. Okay, that's $1 million per taxpayer though. So remember, a syndication could have $10 million of capital gain and you still not have over $1 million on your tax return. So just do remember that. He's proposed eliminating the oil and gas tax benefits, which has been a major tax benefit for that industry. So a lot of the industry specific tax benefits he has proposed. Remember also, though, that Mr. Obama also proposed eliminating a lot of those tax breaks. And just because they're proposed doesn't mean they'll get enacted. However, as Russ pointed out as we were talking before the show, the staff of the Joint Committee, which is really who writes the tax law. Okay, that's the Joint Committee is the Senate Finance Committee and the House Ways and Means Committee. Those are the two tax writing committees. They maintain a list of tax incentives, and they actually have a list of how much they're worth. Okay, so you probably know the biggest tax incentive in the U.S. is the non-taxability of health care coverage. That is by far the largest tax incentive. I mean, like it dwarfs everything else.
Wow.
The state tax deduction was a big one. That actually raised a lot of money when that was limited in 2017. That was one that had been on the list for 30 years.
Okay.
Okay. So these things are on the list. So the intangible drilling cost deduction, the depletion deduction, those are on the list. Okay. Certainly, the interesting one would be the conservation easement deduction, because that kind of it's a real estate benefit, but at the same time, and it benefits high income taxpayers, but it's a conservation benefit. So that I'm dying to hear that discussion in the Biden administration, right? Because they're fighting against themselves on that one. So when you see these increase, and they're talking about an increase in corporate rates and an increase in individual rates, those probably would happen. Okay, it's really easy to increase rates. This is why broadening your base, which is what happened in 1986, is dangerous, because you broaden the base and you lower you lower the rates. But then it's easy to just leave the base broad and then raise the rates. And so raising the rates is, I think, likely under Biden. He'll raise the corporate income tax rate. He'll raise the individual income tax rate. He's proposed eliminating or phasing out the qualified business income deduction. And, by the way, proposed a full Social Security tax on income over 400,000. And here's what will be interesting. Will that include, if it does that, which creates this weird donut hole, right? Right now it goes up to 137,000, cuts off, and then it just cuts off forever. And then he brings it back at 400,000, but in between you don't have it. It's a weird donut hole. But then on top of that, we have the net investment income tax, right? Which is an income tax on capital gains and real estate and other things. Will he add Social Security tax to that? That's an interesting proposal. Okay, will he do that? Will he add a wealth tax?
Right.
Okay, which is an estate tax, but it's an estate tax you pay every year. It's like property tax. So there's some really interesting proposals, and as Russ suggested, something we can't ignore, even though they won't necessarily happen, okay, in the next 4 years or 8 years or whatever. They get on the list, and eventually something gets on the list, it can be enacted. If it's not on the list, it's not going to be enacted. It's got to get on the list, and it has to raise up in level of importance. Okay, that's what happens. Things come up the list, things go down the list. And they actually literally have a list of 100 items that they focus on. And that's the list when they're looking at legislation. So, everybody said, well, the 2017 Act, wow, they just put that together so fast. No, they didn't. They didn't put that together fast at all. I mean, they wrote it quickly, but they already had all those things were already on the list, right? The one thing that they had to come up with was the qualified business income deduction, because that had never been on the list before. Because that had never been contemplated. If you reduce the corporate rate, what do you do about the business rate for pass-through entities? And so that was one they did have to scramble on. And some of the international stuff they had to scramble on.
Right.
But by the way, Biden would also increase the rate on exports. I mean, it's really more like you look at the Washington state tax, which is a basically gross receipts tax. I think of the Biden tax like that. That's really a tax on everything. And that's pretty much what Biden is suggesting, is a tax on everything, especially if you make over $400,000 a year.
Well, and there are other countries, as you know, that do that, and they argue it's for simplicity or whatever the case is, and they probably don't have as complicated tax laws as we do.
Sure.
But what you point out also is why it makes tax planning difficult. We don't know the changes that are coming. You talked about how we can go back and amend sometimes, which is great. An article came out this week that people were scrambling, high-income taxpayers scrambling to file their 2016 amended taxes because of the potential change in the Affordable Care Act. So there's the tax that happens this year while you're earning money for next year's tax return, but then when you can go back, you do. What happens in that case? If we get another sweeping tax change, then is everything nullified and taxes that are already filed are in the books, or is there the opportunity to go back and make changes there as well?
Well, let's talk about a couple of things. First of all, let's talk about that article that came out about filing, it's called a protective claim. So there's a case in the Supreme Court to overturn Obamacare, the ACA. And the question is, if you overturn that, do you also overturn the net investment income tax, which is the 3.8% tax on investment earnings? If that gets overturned and your statute of limitations has run, because you have a 3-year statute of limitations, then you lose the opportunity to go back and get that money. Okay, in case that court case comes out in your favor. Now, my guess is they're not going to repeal the net investment income tax. I think that's a long shot. However, if you'd filed by April 15th for your 2016 tax return, then your statute of limitations, actually, you got an extra 3-month statute because of this extension from April to July. And so it ran out in July.
Yep.
We actually did have a client that we filed a protective claim on for that. A lot of people, though, who had net investment income tax didn't file their tax returns until September, October. So people still have an opportunity. Most people who paid that tax in 2016 can still file that protective claim. They're not dead in the water. So you're listening to this show and you should be going back to your 16. Basically, you should file a protective claim for 16. You might want to file a protective claim for 17 while you're at it, just so that you get it in there in case this takes longer, whatever happens and, we get more, whatever the deal is there. But definitely want to file that protective claim. Now let's look at the next issue, which you'll have to remind me what it is, because I'm I'm old now.
Well, Tom, you talked about the 1031 tax deferred exchange, and of course, for the last few years, you've been sharing with our listeners and our seminar attendees that the whole idea of a 1031, which has been a good tax tool for many years, is less important with bonus depreciation. Maybe speak to that first, and then the possibility of not having the 1031 law. And then I also want to transition to talk a little bit about 1031 and tenant in common, and also the Delaware statutory trusts.
So on the 1031s, the reason they haven't been as important is because of the bonus depreciation. So in many cases, you're actually better off selling the property, recognizing the gain, and taking the bonus depreciation on the new property.
Right.
Okay. Not only do you not have a 180-day window, what you do have is a window, though, is current taxable year window. So in other words, if you sell in 2020, you need to buy in 2020 to offset that. If you do a 1031 exchange, like, you're July or later, you do a 1031 exchange, you don't have to close that till 2021.
Yep.
Right? You have 180 days. But if you decide not to do a 1031, you actually need to close on your new property by December 31st to get the bonus depreciation to offset the gain.
Got it.
So there's some timing issues that you have to look at. One of the big reasons that we do 1031 exchanges, we do, buy, borrow, die, right? You buy the real estate, you borrow from the real estate, and then you die and you get a basis step up. Well, one of Biden's proposals, which, by the way, was actually enacted at one point. You guys are too young to remember, but I do remember that we actually had a carryover basis. So we didn't have a step up in basis. The estate tax went away and we had a carryover basis. Well, Biden's actually suggesting that the estate tax gets bigger and we eliminate that step up in basis, which means that you'd want a 1031 and you'd want to do it in such a way that you could 1031. Let's say the 1031 stayed, but the basis step up didn't stay.
Yeah.
You'd want to be able to 1031 forever and ever and ever. So generational 1031s is what you would want to do.
Right.
And how you set that up makes a big difference, because let's say if you own that personally and you die, you can't do another 1031.
Game over.
But if you owned it in an LLC that was a partnership, that partnership can keep doing 1031s. Now, your other point was, I remember now, was what happens? Does it go retroactive? Typically not. Okay, it's really bad tax policy to have anything retroactive. Really, really bad tax policy, because the reason that people like to invest in the U.S. is because of the strength of our legal system. It's not just the strength of the economy, but it's the strength of the legal system. You know what you're going to get for the most part in the United States, where you don't get that. I had a buddy in Russia once tell me that in Russia, they look at laws as suggestions. This is not something we absolutely have to do. It's just a suggestion.
That's awesome.
And but in the US, it's not a suggestion, right? It's a law. You follow the law. And so if you make it retroactive, then you actually not just changed it in the middle of the game, you changed it to the beginning of the game. And then people don't have confidence. And so it's really, really bad tax policy, and it's recognized as such. So it's pretty rare that you see a retroactive change. Now, it will be effective from the point it's proposed. So this is why it's so important to be watching this as you go. Let's say Biden gets elected in November. January, he gets inaugurated. Now let's start to look at what's he proposing in his first budget, because it's that budget that's going to tell you what he wants to do. That's the budget. And the budget comes out in June, right? So you want to look at what's he going to do in that first budget and look at those proposals, because, Russ, that's where you really have to look at, anything that's in that budget, that's on his wish list. Okay, that's on his wish list. So you want to take action early, and estate tax is a really good example of it. I'll tell you one change that will absolutely happen if Joe Biden's elected, and that is the estate tax exclusion will go down. It's currently $23 million for a couple, $12 million for an individual, approximately, and that will go way down. Okay, we know that exclusion will go way down. So you want, but it won't go retroactive.
Okay.
So if you do your estate planning now, then you're safe forever with that exclusion. That you've used up because you used it up, right? You've actually used up your exclusion. So you want to make sure that there are some things we want to be doing in the next 12 months that we do not want to wait on. You cannot wait on the tax planning. This is, of all the times to do tax planning, we've actually seen a huge uptick in people asking us for help with their tax planning, because people see this coming towards the end of the year. They see it coming next year. You've got some time. And remember, some of these things take 3, 4, 5, 6 months to put into place. I mean, an estate plan, you've got trust documents to do. You've got all sorts of entities to form. So this is not something you want to wait on. This is something you want to do right away.
Yeah, good stuff. Hey, before we get you out of here, Tom, let's talk about the Delaware Statutory Trust, because a lot of folks who decided to invest in a 1031 went into a tenant in common investment, structured investment, because it was easier, less hassle later in their lives, whatever the reasons were. And of course, you know, you're a faculty member for our Secrets of Successful Syndication seminar. And when you're a syndicator looking for funds, if you're going to consider taking a 1031 investor, there's a whole myriad things to consider. But this is a question that we're getting a lot of input and questions on, is the Delaware Statutory Trust as a vehicle for syndicators.
So here, let's look at the big issue for syndicators when it comes to 1031. A tenancy in common, remember, is an undivided interest in the property.
Yep.
Right? So if you have 50 investors in a property, and every investor now has a 2% undivided interest in the property, well, that's like herding cats. I mean, how do you get the management done? How do you get, are you really going to sell just a portion of that?
Right.
I mean, do you have buyers out there that are going to buy 76% undivided interest in that property where they've got 24%? And the likelihood is almost zero, right? I mean, there's just such a small likelihood. People say, well, I want to be able to do a 1031. Well, but you're going to sell the whole property. Okay. It's just challenging. The ticks were really popular, but they got some court challenges and they just are messy. So a way to clean that up is the Delaware Statutory Trust. And it just makes the management and the, workings of that group of investors, it makes it easier. It's not as easy as a limited partnership or an LLC. Let's be clear. It's not as easy as that, but it's easier than a tenancy in common. And so that's where people are, if you really want to have the ability to do a 1031 out of your transaction, then that's fine. Then you ought to be looking at Delaware Statutory Trust for sure.
All right, good stuff. Well, as always, we've learned a ton today. We appreciate your time and energy. Always good to get around Tom Wheelwright. Let's talk for a minute about your podcast. Super excited that you finally got off your butt and decided to do the Wealthability Show. How's it going?
Oh, you know what? It's a blast. I'll tell you an interesting one. I just did a podcast the other day with Morris Pearl from BlackRock.
Wow.
And he leads the Patriotic Millionaires group about we need to increase taxes on millionaires. We need to increase taxes on capital gains. And I asked him, I said, so tell me, how much have you voluntarily donated to the federal government? And he goes, well, nobody wants to pay more taxes. He says, but if everybody does, then I'm okay doing it. I'm going, you're so full of, what? I mean, I'm sorry, when I get around you guys and the Rich Dad guys, we're all about taking control of our own lives and doing things and taking action and so forth. And to say, oh no, I'm going to wait till everybody else does it before I do it. I mean, it's like, so you're not going to donate to charity unless all of your buddies donate to charity.
Wow.
Or unless you're forced to donate to charity. I'm going, it's so disingenuous to me. It was so bad. I did that podcast. Then I had to do a podcast about that podcast because it got me going. So I love it. I learned so much. I mean, I learned a lot from him. I mean, he really is. His whole thing is all about capital gains. That's the biggest thing. And frankly, Wall Street doesn't contribute to the world, so they should pay more taxes, right? In my opinion, I totally agree that Wall Street should pay more taxes. But it was just it's so interesting to have these guests. I had Richard Duncan on my show, and he has such a different view of monetary policy.
Yes, he does.
And it's just, I just think it's fascinating. I like you guys, I love to learn. Most teachers love to learn, right? That's why we teach, because we love to learn.
Yep.
And every time I'm doing a podcast and I have a guest on, I learn way more than anybody who's listening to the podcast. And I absolutely love it.
Well, I hear you loud and clear, because that's true for me today. Thanks to you, my friend. Thanks so much for being with us again.
Absolutely. Thanks for having me, Robert.
There's CPA Tom Wheelwright. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
With everything going on in the world, don't let your lack of financial understanding derail your investments. Real estate investors need to see the bigger economic picture. The Federal Reserve, bonds and interest rates, precious metals, oil and gas, cryptocurrency, and the inner workings of monetary policy, just to start. If you're at all confused about how and why market metrics intersect and what it means to you as a real estate investor, take your understanding to a new level with the Future of Money and Wealth video collection. Discover the opportunity to hedge against inflation, deflation, and stagflation. Gain critical insights on real estate niches that perform well in challenging times, and learn specific strategies to fortify your balance sheet before it's too late. Simply send an email to future@realestateguysradio.com for all the details. The Future of Money and Wealth includes 20 videos of powerful presentations and panel discussions featuring Robert Kiyosaki, Peter Schiff, G. Edward Griffin, Dr. Doug Duncan, Simon Black, CPA Tom Wheelwright, Brian London, Dr. Chris Martinson, and many more. Email future@realestateguysradio.com today.
Don't be like Charlie, who scans the internet for IRA information, often getting bad information from copycats who have no idea what they're doing. You deserve to work with a reputable firm that specializes in one thing, the EQRP. Lucky for you, Congress just made it possible for you to get up to $200,000 out of your current 401k or TSP, so you can invest that money in real estate or even your own business. Even if you're still working, it's possible to get access to all this money tax-free. Whether you're a full-time investor, a doctor, or a government employee, even if you have employees, the EQRP is your secret weapon. You'll never see this strategy in Money Magazine, only here with the Real Estate Guys. Every major accounting firm in America is quietly sharing this strategy with their wealthy clients, helping them get their funds freed from 401k jail. Hi, I'm Damian Lupo, and we have your solution. With the CARES Act expiring soon, this strategy will be gone forever. The EQRP company is ready to help you unleash your retirement funds now. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report today.
Hi there, this is Danielle DiMartino Booth, author of Fed Up, an insider's take on why the Federal Reserve is bad for America, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Oh my gosh, what a whirlwind. It's always informative to get around Tom Wheelwright.
Yeah, you know what I appreciate about Tom is there's no notes, there's no reference books. He's not coming in. I mean, we really didn't prep him on what we were going to ask him. We just said, hey, come on in. We have some things we want to talk to you about. And boom. So, he knows his stuff. And I think, really, I mean, we could try to talk about some of the details, but I think, big picture, and I think you have to stay big picture, because if you get too far into the weeds, you lose sight of the big picture. And if you lose sight of it as a CEO of your portfolio, of your business as a syndicator, as a real estate investor, then who's got the big picture? So you've got to surround yourself with smart people like Tom that are in the weeds in the tax code, lawyers who are in the weeds in transactional law and how to protect your rights in a contract and all of that, your property managers, your brokers when you're, actively doing a deal. Clearly, based on what Tom said, you're a estate planning attorney. I mean, a lot of people still today, it just boggles my mind. I mean, I get it for residential 1 to 4 because the lending is very friendly and it's just a hassle to try to get those properties financed outside of your own name. But anything else, I mean, to own an apartment building in your own name or to do any, I mean, that's crazy. And now when
That's double dumb.
Yeah, and when you begin to understand that, and I think one of the things that didn't come out in what Tom said that I think is an important part of understanding the estate planning side of things, and that was one of the things he felt like he had urgency on, is that when you set those entities up, one of the major reasons to do it is they exist in perpetuity. That's the whole concept of a living trust. And that way, when you die, the entity, the ownership is continuous. It doesn't die. And so you can still, your executors or the people who are managing your wills, your trustees, they can continue to manage the assets for the beneficiaries at the optimal level. And you don't have to deal with these estate taxes if you've done it properly. And so entity structuring is also a very big part of your tax planning. They kind of go hand in hand.
You know, I think just listening to Tom, it also should be crystal clear that you need the right tax person in your corner. I know a lot of real estate investors that we meet, they're like, well, my tax person isn't great, but I've used them for years. At some point, when you make the jump and become a real estate investor of any stature, you may have to make a team change. That's just how it is, because there's a lot of great tax people that are perfect for W-2 employees and standard deductions. But when it gets out to the unique stuff, you know, when we're talking about opportunity zones and these Delaware statutory trusts and 1031 law even, you need someone who really knows that stuff. And of course, what Tom does today, even though Tom does do some tax returns for a small handful of friends and high income earners, what he mostly does is to educate other tax professionals. That's kind of his passion. He loves to educate people about taxes who pay taxes, but he also loves to educate the educator. So to find out more about what Tom does and to get a free chapter from his great book, Tax-Free Wealth, that discusses how to choose the right tax professionals, all you need to do is send a quick email to taxpro@realestateguysradio.com, taxpro@realestateguysradio.com. There you'll also be able to sign up for Tom's free weekly tax report. Tom was also gracious enough to give us a big chunk of time in the COVID-19 Crisis Investing webinar series. So if you have not yet signed up for that, well, we're singing out of this songbook, but it's about to be released, and all you have to do is send an email to crisis@realestateguysradio.com, crisis@realestateguysradio.com to be invited. And Tom was kind of an outlier in that what he talked about was the stimulus and about tax.
Well, COVID-19 has affected all aspects of life. You know, we all understand what it's like to be in lockdown. We know what it's like to have to wear a mask. We can see stores closed. We see the unemployment numbers climbing. You know, we can see the stimulus going on at the federal reserve level and even at the government level with spending and stimulus checks and whatnot. Tax is a little bit under the radar. It's a little bit more esoteric. And if you aren't paying attention to that corner of the financial universe, you miss it. But the policymakers are definitely using it as a very powerful tool to drive behavior. Always have. I mean, they always have. But until you start really taking tax as a serious aspect of your professional portfolio and business management, a lot of times people only deal with tax after the fact, right? I mean, they go about their business, they think about how to use capital and how to use labor and how to use leverage and but then they think about tax only afterwards, and they're not proactive. And I think the big lesson here is that things are moving very quickly. The policymakers are very actively tweaking the tax code, which affects your bottom line, and that's the one you should be concerned about. And the time to think about it isn't after the fact, it's on the front end. And that's why we thought it was important to get Tom on board with the potential for an administrative change and a change in policy in 2021 and going forward.
Big thanks to Tom Wheelwright for always educating us, not only about what the tax law looks like today, but where it may be going. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton.
Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.